Hello and a warm welcome to Advanced Audit and Assurance, your path to AAA excellence. If you're gearing up for the AAA exam previously recognized as a P7 exam, you're at the right place. In this video, we will walk through the past exam questions. Get ready. We're not just studying the past exam question, we're unlocking the secrets to decoding the scenarios, finding numerous points we can make in the exam to gain marks easily, masterfully crafting answers up to the examiner standard, and skyrocketing your chances of success in the AAA exam. Stay tuned for game-changing insights that will transform your approach and elevate your ACCA journey. Let's go ahead.
Will cover up question number 3A of September 2020. Let's read the question and try picking up points from the scenario and try to solve the question. Let's draft the answer for this question. Let's begin reading. Please follow me. It is 1st July 20x5, today's date, right? You are the manager responsible for the audit of Myron company. You are the manager responsible for the audit of Myron company, a listed company, again, a listed company. And you are in the process of completing the audit of the financial statements for the year ended 31st March 20x5. Okay, the dates are always important in your AAA exam, and the company nature of the company, that it is a listed company or a private company, is also important, equally important. You need to mark this whenever you are reading the case. Let's read further. The auditor's report is due to be signed in the next few weeks. Okay, so this means that we have completed our audit and the auditor's report is about to be signed or due to be signed in the next few weeks. We are over the completion stage as mentioned earlier over here. We are completing the audit of the financial statements. Now, the company's principal operating activity is the publication of trade and scientific journals. Okay, the company's business is publication of trade and scientific journals. The draft financial statements recognize revenue of 108 million for the current year, and for 20x4 it's 102 million. So there's an increase by 6 million for the revenue, right? So we need to these figures are important. We need to mark them for the current year especially. So revenue of 108 million, we have highlighted this. Profit before tax of 9.3 million for the current year 20x5, and for 20x4 for the previous year 8.2 million. For the 20x4 it's 8.2 million, and the total assets for the current year are 150 million, which has only increased by 1 million during the year. Now, you are in the process of reviewing the audit working papers and have identified the following potential issues. Now, there are two issues being highlighted. One is sale of division, and the other is first time adoption of IFRS 16 leases. Alright, so let's read further details what the case or what the issues are. Sale of division. Myron company is at the advanced stage, that is, at a later stage or at a finalizing stage, advanced stage of negotiations. So it's negotiating, so it's at the finalizing stage. Advanced stage of negotiation is finalizing stage to sell its scientific publishing division to a competitor. Scientific publishing division, it's a division, right? We are talking about. This division contributed revenue of 13 million, revenue of $13 million, and profit before tax of 1.4 million during the year to 31st March 20x5. So for the current year, this division, scientific publishing division, has made a revenue of 13 million individually and a profit before tax of 1.4 million dollars. The draft sale agreement, which is due to be finalized by 1st August 20x5, so at the year end 31st March 20x5, it's certain that this division is going to be sold in the upcoming year, and it is certain that it is at the finalizing stage of the deal. So there's a draft sale agreement which is due to be finalized by 1st August 2025, shows an agreed sale price after cost of disposal of $42 million. Right? This is an important figure. It's the sale price of the division, scientific publishing division, and we will use it in the answer we draft. The division is a separate cash generating unit, so it's an independent unit. It's a separate cash generating unit means this division operates independently. It has its own revenue, it has its own cost, it has its own assets and its own profit. So it's a CGU, cash generating unit of Myron company. None of the assets of the division are held under a revaluation policy, and depreciation is charged on a straight line basis over the determined useful life of the assets. So that's right, no issues with this sentence. It's just telling us the depreciation policy and the revaluation policy of the division. The finance director of Myron company has not made any disclosures with respect to the upcoming sale in the financial statements for the year ended 31st March 2025, as he considers it to be part of next year's accounting transactions. So this is something I don't agree with. What about you? Do you agree? See, it is at the year end. We have already been given that there are advanced stage of negotiation for this division. This division is an independent cash generating unit CGU, and uh, when this is certain that this unit is going to be sold by the 1st of August, it is going to be finalized. This means in the next 12 months we will be making a sale. We have found a buyer for this division. We were actively trying to sell this division. We have found a buyer for this division. In the next 12 months it is probable that it will be sold. Then there needs to be a disclosure, right? The accounting treatment. I hope you are following what I am saying, or what the accounting treatment I just summarized. So let's read this point again. This is really important point. The finance director of Myron company has not made any disclosures with respect to the upcoming sale in the financial statements for the year ended 31st March 2025. Right? So the finance director has not made any disclosures in respect of this upcoming sale in the financial statements, as he considers it to be part of next year's accounting transactions. So you recall the accounting treatment. We are actively seeking a buyer. We have found a buyer. It is probable that the sale will be made within the next 12 months, and the prices are ascertained, $42 million. Right? So we are having so many accounting conditions being met. So this needs to be identified as a separate selling unit. Yes, we need to identify this unit. It's a separate unit, independent unit. We need to identify this as a held for sale, asset held for sale. We need to bring it into our current assets portion at the end of this current year, because it is certain that it will be sold within the next 12 months. All the accounting treatments or the conditions are being met over here. So we will have to identify this cash generating unit as a current asset instead of a non-current asset, and we will have to make a separate disclosure. We will have to separately show the revenue of this department, the profit before tax of this department, and the assets of this department. We will have to make it an independent unit and show it in the current assets section, which the finance director has not done so. Not made any disclosures, right? I am marking this. Then, however, the division has been written down from its current carrying value of 45 million to its estimated value in use of $41 million in the financial statements for the year ended 31st March 2025. Now you brainstorm yourself, you think yourself, what's happening in this case? We have identified a division, scientific publishing division, as a independent unit, that is a cash generating unit. It is a separate division which is being sold or which is about to be sold. It's at the finalizing stage at the year end of this current year, and it is probable that the deal will be finalized by 1st of August 20x5, and this asset should be disclosed as a current asset instead of a non-current asset, and its sales, that is revenue and profit before tax, should be disclosed separately in the disclosures, but there is no respective disclosure being made by the finance director, and the finance director has brought this asset from its carrying amount of 45 million to its expected value in use of 41 million, whereas it is probable that the asset deal will be made for 42 million for this division, which which is the amount of sale proceeds less the cost of disposal. Net is 42 million, which we are going to fetch from the sale of this division. So bringing it down to $41 million, that is the value in use, is understating the asset. It's understating the asset over here in this case. Further, we will discuss when we start solving or drafting the points. Rather, let's begin drafting the points for this one first. Let's read the requirement. We need to comment on the completion matters, right? The completion matters to be considered in relation to the issues described and recommend further actions necessary. We need to comment on the completion matters, that is the sale of division and first time adoption of IFRS 16 leases, and we need to recommend the further actions necessary before the auditor report can be signed. Okay, and part 2, and evaluate the implications for the auditor's report if no adjustments are made in the financial statements. That okay. So we need to comment on the completion matters, that is these two matters, sale of division and first time adoption of IFRS 16 leases, and we need to recommend further actions necessary. Then we need to evaluate the implications for the auditor's report if no adjustments are made in the financial statements. 15 marks altogether. So I hope you have followed the paragraph we read of sale of division. First, let's draft points for this one. Then we will move on to IFRS 16 leases, so that we are clear with one part of the question or the case, and then we move on to the next part step by step. So let's start drafting points for this one. First, let's give a slight introduction. The company is at an advanced stage of negotiation with a competitor, because we are already provided with this information, we are just trying to copy it back, to sell its scientific publishing division, right? And we will provide this point also, that the finance director has not made any disclosures with respect to the upcoming sale in the financial statements. The company is at an advanced stage of negotiation with a competitor to sell its scientific publishing division, and the finance director has not made any disclosures for this sale in the financial statements. Right. Now, see, we are provided with the revenue 13 million, profit before tax of 1.4 million of this division, and we are provided with the company's revenue 108 million and profit before tax of 9.3 million dollars. So don't you think we can calculate the materiality of this division, that these figures are material or not? Yes, we can. So let's begin. See, this is a revenue of $13 million. 13 million divided by the revenue of the company as a whole, 108 million. So this contributes to 12%, 12%, 12.03%. So this is 12% of the revenue that is material. And then let's check on profit. 1.4 million divided by 9.3 million of the company multiplied by 100. So this contributes to 15% of the profit before tax. So this is also material, right? Material by figures. Now let's see, the value in use is 41 million of the division divided by the total assets of the company, 150 million, and this makes it 27.3 million, 27.3%. So the division assets are also material by the figure. So let's tell materiality. In this case, we need to tell the materiality figures so that we can gain marks for the materiality figure calculations. So let's begin. The revenue of the scientific publishing division represents 12%. The profit before tax represents 15%, and the total and the assets value in use represents 27.3%, right? So we can give a statement that the division is therefore material to the financial statements, right? See how we have drafted the point. We have told the materiality for the division in three of the cases. That is revenue, profit before tax, and the total assets. Now let's come back to the case. Now we can tell the examiner that we know the accounting treatment, right? That is, it is to be held, the assets held for sale are supposed to be disclosed and are to be treated as current assets rather than non-current assets. So let's make a point and tell the treatment, or tell the that we know the treatment for this to the examiner. So we can write that the accounting treatment, or we can say the accounting standard, not the treatment, actually standard requires this. Accounting standard requires specific disclosure in relation to the assets held for sale and discontinued operations, because this is being discontinued, right? And further we can include like in including recognizing this division as a current asset, and the results of this division shall be represented or shall be presented separately, right? As I mentioned, separate, presented separate, okay, separately in the financial statements and the cash flows, right? Cash flow also will change. Okay, now we need to tell the accounting treatment for this one also, the conditions to be met. So we will briefly state the conditions, and then we will explain or connect it with our case. So we can say that in order, because we need to tell the examiner we know the answer or we know the accounting treatment. In order to be classified as held for sale, the following conditions should be met, right? We are going to specify the conditions to the examiner that we know the accounting treatment or the accounting standard, and based on that we are giving our answer. So we can say commitment to sell, right? The first point. The second is that the asset is available, the asset is immediately available for sale. Then the third one, uh, an active program to search for the buyer. This is also being met because we are under the advanced, under the advanced process of or advanced stage of completing the sale, and the sale is probable in the next 12 months. So this condition is also being met, right? Right, we have mentioned the conditions, and based on this we are going to write down connect it with our case. But in this case, one more point, yes, I forgot. The asset is being actively marketed, right? So now we have stated the conditions of the IAS, right? Now we are going to connect it with a case. The scientific publishing department or division we can say the scientific publishing division no rather we can say the management has found the buyer for the scientific publishing division, right? So first condition being met, and the sale is at the advanced stage of negotiation, right? And further we can say that the sale is highly probable, and along with this we will mention to take place within 12 months, right? So I think we've completed this part of the connection with the case. Now see, the question was telling us to evaluate the comment on the completion matters. We have told the matters in relation to the completion, right? And we will tell the further actions also. Rather, I think further actions we and recommend the further actions necessary before the auditor's report can be signed. So we can tell about the completion this further actions at a later stage, connecting or together for both of the points. Right now what I am willing to do is that we can tell that this non-disclosure is going to mislead the user of the financial statements. We can make a comment for this one, that the non-disclosure in the financial statements will mislead the user and with what why would the user be misleading for the user? Why would it be misleading the user? It would mislead the user with respect to upcoming revenue, profit, assets and cash flows, right? All these documents would get misleading for the user for the upcoming next 12 months. Now we will tell what the will how will this impact, or what implication will this bring on the auditor's report. We need to tell this also. Or rather, let's first go step by step. We have discussed the completion matters. Now let's tell the further actions which need to be taken. So let's tell further actions. We need to, simplify or make it easy for the examiner to read the answer. So that's why I'm mentioning this, that we are telling about the further actions in this case. And over here, first we can, in the previous one, over here at the top we can first we gave the introduction, then over here we can mention that sale of division. We are trying to make it easy for the examiner to locate points so that they can award us marks. And right now it just came in my mind that we haven't told anything about the valuation. the 41 million and the 42 million, right, just came in my mind right now, that the value in use was 41 million and they had brought down this current carrying amount of 45 million to its value, estimated value in use of 41 million, whereas the actual negotiation was going on for 42 million. So don't you think that we will use these figures to make another point? We'll gain one more mark over here. So let's draft 1 point for this one. And further, IS 36 impairment also applies over here. Impairment of assets also applies, because the current carrying value of this asset was 45 million and the company brought it down to value in use of 41 millions. So this means that IAS 36 impairment of assets also applies over here. You know, it's only such a small paragraph. It's like roughly 1, 2, and 3, short paragraphs, but there are so many points to consider or so many points to make. So let's begin. We can say that prior to classification, as held for sale, the company needs to check the division for impairment. Now, if the company undertakes impairment, what would happen? The impairment test would require the asset to be held at the lower of cost, or actually the lower of carrying amount, because now there is no cost, right? It's the carrying amount, asset cost minus the depreciation, the carrying amount, and the recoverable amount, that is 42 million over here. Right? Now we will tell what is the recoverable amount. The recoverable amount is the higher of, right? We need to bring it as lower of carrying amount or the recoverable amount, but the recoverable amount is the higher of value in use or the fair value less cost of disposal, which in this case is 42 million, the fair value less cost of disposal, rather than the value in use of $41 million. So now we've just told the accounting treatment in this paragraph. You are noting this point. Now we have told the accounting treatment to the examiner about the impairment. Now we will tell the examiner what the case is, or we will connect it with the case in this case. Now actually in this case, the recoverable amount is $42 million and the estimated value in use is $41 million, right? We have told what the figures are. Now what we will do, since the company has brought it to value in use 41 million instead of recoverable amount 42 million, This means that the assets and the profits are being understated by $1 million. Yes, as I mentioned when we were reading the case. So let's write this down, or let's tell the examiner that this means that the company profits and assets are being understated by $1 million. Or rather, we can add an other line over here, another sentence. The company has recorded this division at the estimated value in use of $41 million. Now this means that the company profits and assets are being understated by $1 million. You get my point. I hope you are following me. Because see how from such a small short 3 paragraphs of sale of division we have drafted so many points. We have told the examiner the treatment, that we know the treatment, we have studied the accounting standards, then we have told the examiner what the treatment actually is, or how it was supposed to be treated, and what are the deficiencies, what has the company itself done. Right, now it's time to come to the to further to tell what the further actions could be for this case, in this case given of assets held for sale. Now the first one we can draft is what do you think? First you think. Now I want you to think first, then I will draft my points or tell my points. First I want you to think what do you feel, or what do you suggest should be the points or the further actions in this case. I hope you have thought some points, or you have made up some mind what could be the further actions, right? So let's discuss now. I want you to discuss. See, the first action we would take is we would ask the management to make the changes in the financial statements and to recognize the asset as held for sale as discontinued operation held for sale, right? And to make the appropriate disclosures for the held for sale assets held for sale in the financial statements, right? Then what we can do is that we can tell the management to correct the carrying amount of the asset to the recoverable amount, that is 42 million instead of 41 million, because the company has recorded the division at 41 million, the value in use. So we would ask the management to bring it to 42 million instead of 41 million, right? And what else? If the management refuses to make the changes, we would approach those charged with governance. Since it's a listed company, we were told it's a listed company. So if the management refuses to make the changes, we would ask, or we would seek, or we would ask those charged with governance to make these changes in the financial statements, and we would tell them if they do not make these changes, what would be the repercussions, or what would be the impact of this on the financial statements and the auditor's report. I hope you are able to follow what I am saying. And did you think of the same points? I would like to know this too. And towards the end, if the management still refuses, or if those charged with governance still refuse to make the changes, what is the last choice with the auditor? One is to give an adverse opinion, or give an adverse opinion, or give a material misstatement in the financial statements, write a qualified report, and further, what action can the auditor take? Obviously, the auditor won't keep the burden of proof on the auditor. So the auditor would demand a written statement by the management or those charged with governance in this case, that the auditor told them these changes were required, but they have refused to do so, and because of which the financial statements are misstated. You know, you're able to follow what I'm saying. I think we should delay this further actions a bit more, and we should take this, or we should start with the first time adoption of IFRS 16 leases first. I feel like, I don't know, but see, let's see. Myro company operates from leased premises, that is, it's operating from its leased premises or rented or rental properties, and additionally holds leases for printing equipment for journals. Okay, these leases these leases are material to the financial statements. Okay, the company has adopted IFRS 16 for the first time this year. Okay, let's highlight this one for the first time this year, and has adjusted the opening balances and equity without restating comparatives as permitted by IFRS 16. So the treatment is perfect, the treatment is correct, because IFRS 16 requires you to, if you're making changes, you can make it since from the opening balances without restating the comparatives, or you can restate it from the current date, but you will have to give a disclosure, and you will have to give all the comparatives and stuff if you are giving it from the current date. So however, the company has adopted it for the first time this year, but the company has made the adjustments from the opening balances and the equity without restating the comparatives as permitted by the IFRS 16, and that is perfect treatment by the company. So the company is doing something good and something not good. Now, there is, however, no reference to in the financial statements to the change in policy or the reasons for making the changes to the accounting policies. Right. So there's no reference given, that is, there is no disclosure in the financial statements, and we need to give the disclosure for this, that we have changed our policy and we have made these changes, because the impact from opening balances would be coming on year by year. Now, the adjustments have already been checked by the auditor team and deemed appropriate. Okay. So, brainstorm yourself. What do you think? Do you think are issues we can highlight, or we can make some points from this one also, or no? So let's draft some points for this one also. First time adoption of IFRS 16. So we can say adoption of IFRS 16. Right? Now what we can do? We can state the accounting treatment for IFRS 16 done by the company is correct and in line with the accounting standard. Right? We have told that the company has done the correct treatment of the accounting standard, and this is perfect. We have mentioned what is right. Now over here we were given the information that this has not been disclosed in the financial statements. However, no reference in the financial statements to the change in policy or the reason for making the change to accounting policies is given, right? So we would mention about this thing that this was required. We can say that the lack of disclosures of the change in accounting policy uh, is not in accordance with the accounting treatment, or we can say accounting standard, right? The omission of disclosure is likely to be material to the financial statements, right? Now, this was like very short because over here we cannot draft so many points, but however, let's scroll upwards and see we have drafted so many points and we have covered up so many marks till now. Now, let's move on with further actions. As discussed, with this case, we can only tell that the non-disclosure we will recommend or we will require the management of the company to make disclosure for IFRS 16 in the financial statements. I don't think there is any other further action we can take for this one. And the same, if the management refuses, we can we can discuss this matter with the those charged with governance, and we can ask those charged with governance to get the disclosure in the financial statements by the management. And in case if they also disagree, we can obtain a written representation. So it's like the further actions for the sale of division and for the first time adoption of IFRS 16 leases is the same in both the cases. So we will make the further actions now, that yes, this is case and this is further action is required. So it's like it's going to be mutual points for both of them above. So let's make the further actions points. First, we would make that the auditor should request the management to adjust the financial statements to recognize the discontinued operations, that is the division we are talking about, the auditor should request the management to adjust the financial statements to recognize the discontinued operations and to separately disclose them as held for sale, and to disclose, now a point for IFRS 16, and to disclose the changes in the accounting policy for leases, right? We have drafted this point, common point for both of them, for both the cases above. Then we can write yes, we can write about the recoverable amount. So let's draft a point for this one. the client should amend the carrying amount of the assets held for sale to the recoverable amount of $42 million, right? Why should it be being the higher of the value in use or the recoverable amount? Right. Now, one more point which we can draft is yes, if the management refuses, then the auditor should communicate with those charged with governance, right? Uh, Actually, those charged with governance and inform them of the act of the modifications to the auditor report if the adjustments were not made. Right, we are telling them what impact would it have on the auditor's report if the adjustments were not made by the by those charged with governance. Now, what we can do is, if the management and those charged with governance still don't amend the financial statements, a written representation should be obtained from them confirming their intent, that is what they're intending to do, that they're not intending to change the financial statements, confirming their intent and them being aware of the impact on the auditor's report. Right. See, we have drafted the points for this one now. Comment on the completion matters and the further actions. Now we need to draft points for evaluate the implications for the auditor's report. So let's scroll a little bit up. We need to tell the implications for the auditor's report if no adjustments are made to the financial statements. If no adjustments are made to the financial statements. So let's draft it. We will say implications on the auditor's report. Implications for the auditor's report. Sorry. Right. Now let's begin drafting points for this one and complete a 15 marks question or requirement. Right now it's taking a bit time because I'm discussing the case, I'm discussing the points, I'm discussing the answers with you. But once you are in practice, once you are in the exam conditions, you're practicing it at exam conditions, you should keep an eye on the clock and you should write down your answers, draft your answers quickly. Don't invest too much time. If you're stuck, carry on, move forward. Don't waste time for a single mark, staying back and holding and wasting your time in the exam. Now let's write the implications. First, if the management, or rather if the adjustments, because there are two adjustments, are not made, because we have to consider when the adjustments are not made, then there is a material misstatement because the figures are material, right, in the financial statements. Now what would be the implication? This would, because it's a material misstatement, this would result in a qualified audit opinion in the audit report stating, what will it state? Except for the material misstatement in relation to the value of the assets held for sale, the financial statements are stated fairly, right? I'm sorry about the typing, so let's correct and move. Now what other point do you think we can make? There's something non-disclosure, right? So we can draft a point about this one, that there are important non-disclosures in the financial statements that would be required by the users to understand to understand the current and the upcoming performance of the company, right? I hope I am making it easy for you and you are able to understand, grasp what I am doing, and you will be able to perform well in the exam, in the actual exam, because that is where you need to put in your efforts and put in your every practice. Now what else can we make a point over here? Don't you think we are just told that the report would be qualified, but if the non-disclosure has a pervasive impact on the financial statements, then the report opinion would be an adverse opinion. So let's draft a point for this one as well. We are not giving a final answer that it's going to be qualified only, but we are giving the open end result that this could be also the case. It could be an adverse opinion as well. So if okay, it is in the audit it is in the auditor's judgment whether to treat the non-disclosures as what we call as pervasive to the financial statements, then the then an adverse opinion would be considered, as the financial statements as a whole would be misleading, right? So this is it. We have provided that the qualified opinion, when would it be a qualified opinion, and based on the qualified opinion and the auditor's judgment, an adverse opinion could also be given. Now one more easy mark, one more, that could be that about that we can include what is the placement of the paragraph. This is one mark, easy mark. So we can say that depending on the opinion provided, a qualified, or rather a basis for qualified or adverse opinion paragraph would be added under the opinion paragraph. This candidate is an easy mark, one easy mark for the placement of the paragraph. That's it. So see, we were given 15 marks in all for this question, and we have drafted small, short paragraphs, 2 3 lines, maximum 4 lines. But we have told the accounting treatments over here. We have told the how these conditions are being met, and in this case, and the accounting treatment for the IFRS is correct. We have told that, or we have mentioned that the treatment is correct, but that there is no disclosure. This is making the financial statement material misstated. We have told this thing also, and then we have told the further actions required by the management or by the auditor for the management, and then we have so see how we have drafted the points, short points, to the point paragraphs and short paragraphs. So this is how you have to practice. You can watch other videos for your practice, and you can follow me as well. No issues. I am available to guide you. It's a free guidance for everyone, so I am available. So let's move on. Let's prepare for the exam, and let's pass the exam in the first attempt, or even if you are resitting the exam, let's pass it now. It's going to pass if you follow my instructions and guidance. Okay, thank you. Take care.
Towards the end of this video, you need to remember greatness doesn't happen overnight. It's the result of continuous effort, boundless curiosity, and a thirst for improvement. Investing time in these videos and engaging with past AAA exam questions is an investment in the brighter future you're shaping up. Keep your focus sharp, your learning continuous, and your eyes focused on your goals. Best of luck as you navigate your studies. May your dedication lead you to success in the AAA exam.